My name is Fisogo Mbuto, and today I'll be taking you through some of the highlights from our Resilient and Hyprop investment report. So just on the summary side, we had buy recommendations for both Resilient and Hyprop with upsides of 18% and 15% respectively. We base our recommendations on improving fundamentals across the retail sector and both in individual companies. So what we're seeing is when it comes to a rental reversions perspective, on an aggregate for the retail sector, the reversions have been typically moving towards positive territory. Typically what this means is that there is an improving demand for the retail sector space, and with Hyprop and Resilient being one of the retail sector players with the lowest vacancies as well, sort of see that there is some fundamental value there as well. We've been seeing over the course of the last 4 years, and particularly in 2023, is that the property fundamentals have been improving, but the price action hasn't been moving with it, except for in that last quarter of 2023. And then on the other side is we anticipate an uplift in valuation due to property's relationship with bond yields and their expected ease. We'll see that in that last quarter of 2023, property had a really good rally, and it coincided with an easing of bond yields. So around the beginning of October 2023, those bond yields were at about 3 standard deviations above their long-term average, and by the end of that year and the end of that quarter, they were closer to that 2 standard deviation, and coincided with that performance. So we expect that relationship to still hold generally in direction, given where headline and core inflation is relative to SARB's target range of 3 to 6%, and the anticipation of interest rate cuts as well within the year. So that would lead to an easing of those bond yields and a valuation uplift in property performance, and particularly in this case, Resilient and Hyprop. However, we do have a preference for Resilient over Hyprop, and it's primarily due to these 3 following points. First being higher exposure in South Africa by Resilient relative to Hyprop. Resilient has a lot more stores in South Africa. It has a lot more gross lettable area in South Africa, and it's also exposed to a lot more provinces in South Africa compared to Hyprop, which is only in Gauteng and in the Western Cape. And then Resilient also has a lot more debt to be rolled over within the next 12 to 24 months, which could be potentially in a more favorable interest rate environment. So typically in a cycle of interest rates increases, you want to be in those more heavily hedged companies to protect on the downside caused by your interest rate costs increases. But because we anticipate interest rate cuts in that environment, you would want a lot more of your debt to be rolled over in lower interest rate environment, as well as being a lot less hedged to take advantage of that decrease in interest rates. And that's where Resilient is shining a little bit better than Hyprop. And then that last one is Resilient is better positioned in leading in load shedding protection in the sector. You can sort of see that in absolute in their protection or their investment, so to speak, in solar power, as well as the coverage in solar power relative to the gross lettable area. They're number 1 in the sector there, not just in retail, but property as a whole. And when we combine that with the super average cost retake back from tenants of about 71% in the sector, sort of see that Resilient is better positioned because they rely a little bit less on the grid because of the solar power, and a good portion of those diesel costs are actually taken back from your tenants relative to Hyprop, and that's important given the operating environment in South Africa and the risk implications of load shedding. And then in terms of things that would change our minds is more of a deterioration in property fundamentals. We saw that they've been improving over the course of 2023 into 2024. And any pivotal change in the wrong direction would increase our downside risk and change our minds on our thesis for Resilient and Hyprop in the sector as a whole. And then with the other point that would change our minds being an outlook change to government bonds increasing instead of decreasing because of the potential price performance as well as valuation impact that would negatively impact property, and in this instance, Resilient and Hyprop.